Welcome to the Deep Dive. Today we're doing a Talk Ticker special, cutting straight through the noise of the Q3 2025 earnings call for Hut 8.
Yeah.
This company is right in the middle of a strategic whirlwind, attempting to transition from, a pure Bitcoin miner to a major player in energy infrastructure and high-density compute.
And you could really feel the tension in the market after this call. This deep dive is necessary because, like you said, the company delivered huge headline financial beats. The numbers looked great on paper, but the stock immediately dropped.
Dropped hard, yeah.
Dropped really hard. That tells us investors are skeptical. They are wrestling with the, let's say, quality of the earnings and maybe the sheer, almost unbelievable scale of management's long-term vision.
Right.
We need to figure out what's real and what's just, accounting magic, perhaps.
Okay, let's unpack this financial conflict then. On the surface, the performance looks stellar. Revenue blasted past expectations, coming in at $83.5 million. That is a massive 91% increase year over year, significantly ahead of the, $65 to $68 million consensus estimates.
Yeah, way ahead. And not only that, but the profitability looked, astonishing at first glance. Non-GAAP EPS was a loss of 27, but that was still 9 cents better than the street expected.
Better than expected. Well,
and the GAAP EPS actually looks solid at $0.43 per share.
Okay, but the number that really screams success, or seems to, is adjusted EBITDA. It surged from $5.6 million in the prior year to an astronomical $109.0 million this quarter.
Yeah, huge lead.
What singular factor explains that kind of astronomical, almost nonlinear growth? Seems too good to be true.
Well, that's the critical question you need to ask exactly, because if you scratch beneath the surface, you find the answer isn't really sustainable operations driving it all. The key driver, the vast majority of that profit surge, was a significant non-cash item, a $76.6 million fair value gain on their digital assets.
Okay, so explain that. For the learner, what does fair value gain actually mean here?
Right. It basically means this number is purely an accounting adjustment. It's recorded under new accounting guidance, and it just reflects the change in the paper value of their Bitcoin holdings during the quarter.
So they didn't actually receive $76 million in operating cash flow?
No, not at all. It's not cash in the bank from selling services or mining Bitcoin. It's an accounting game based on Bitcoin's price movement.
So if the market sees a $109 million adjusted EBITDA number, but knows or figures out that $76 million of it is just a paper gain.
Exactly.
They're focusing less on that accounting beat and more on maybe the lack of underlying repeatable operational profitability. Is that it?
Precisely. It signals a focus on execution risk. It tells us the market is essentially saying, okay, nice number, but show me the contracted recurring revenue, not just the fluctuation in your Bitcoin stack.
That leads us perfectly into the structural shift they're undergoing, which is where the complexity really spikes, I think.
It does.
When we look at the revenue segments, compute accounted for the vast majority, $70 million, so about 84% of the total revenue.
Right.
And that's largely thanks to consolidating their majority-owned subsidiary, American Bitcoin, or ABTC.
Okay, this consolidation point is where we need to spend some real time because it fundamentally masks the operational success, or at least the activity, of the new Hut 8 infrastructure platform.
How so?
Think of it this way. Imagine Hut 8 is the parent company, right? And they own a large, let's say, coffee supplier, which is ABTC in this analogy. Now, the coffee supplier itself, ABTC, is doing great, generating $64 million in revenue at a fantastic 56% gross margin in Q3.
Wow, 56% gross margin. That's impressive for any business, especially mining.
It really is. Now, Hut 8, the parent, provides infrastructure services to that coffee supplier. In reality, it's 325 megawatts of power and managed services for Bitcoin mining. Hut 8 charges ABTC for those services. This results in revenue appearing in Hut 8's power segment, $8.04, and their digital infrastructure segment, $5.01. But, and here's the key part. Because it's essentially moving money from the parent's left pocket to the subsidiary's right pocket, accounting rules require them to eliminate that revenue during consolidation.
Intercompany transactions.
Exactly. It's treated as an intercompany transaction.
So the power and digital infrastructure segments look artificially small on the consolidated income statement, even though they represent essential, recurring economic activity that Hut 8 provides and is successfully monetizing from ABTC.
You got it. It makes those infrastructure segments look smaller than their true operational value or activity level. This structural change, though, it aligns their capital allocation strategy towards what they see as lower cost of capital businesses like colocation and managed services by parking the high-margin, pure-play Bitcoin exposure into ABTC.
Makes sense. And meanwhile, on the mining side itself, inside ABTC mostly, thanks to the Vega ramp, which is their big deployment of new mining hardware, their operational hash rate jumped significantly. It's now at 23.7 exahash per second, or EHs.
Yeah, 23.7 operational out of about 26.8 installed. That's a massive amount of computing power dedicated just to Bitcoin block production, a huge scale.
Okay, so if we connect all these pieces, the consolidation, the segment reporting, the mining scale, management is clearly trying to redefine the company. They're moving away from being just a miner.
Definitely.
They kept hammering home this idea of a power-first architecture.
They explicitly position the company around power expertise, trying to transcend any single application, whether it's mining or AI or something else. They see power as the core asset.
And this is the foundation for their really staggering expansion announcement. 4 new U.S. sites representing approximately 530 megawatts of energy capacity under development.
Yeah, 1.5 gigawatts in active development. That's capacity they're actively working on to position themselves for, multi-decadal growth, as they put it.
And they even introduced that new metric, didn't they? Energy capacity under development, designed to give investors greater visibility into those huge late-stage projects, bridging exclusivity and actual management contracts.
They did. And the total pipeline they are now tracking, including earlier stage stuff, is approximately 8.65 gigawatts.
8.65 gigawatts.
8.65. Look, that is an absolutely staggering amount of power capacity they're aiming to bring online eventually.
Put that in perspective for us.
Okay, 8.65 gigabit. That's more instantaneous power capacity than many small countries currently consume. It's huge. This is kind of like them trying to build, say, 4 new major manufacturing plants simultaneously across multiple states.
Okay, it's ambitious.
Extremely ambitious. And the market's skepticism isn't really about the ambition itself, I think. It's more about the execution feasibility. Can they actually build all this on time, on budget?
And their own timeline kind of confirms why there's scrutiny, right? The largest site, Riverbend in Texas, is targeting initial service for 300 megawatts of utility capacity, but not until the end of 2026.
Exactly. That's a full 2-year runway from now. And it's filled with potential hurdles, regulatory approvals, supply chain issues for massive transformers, which are hard to get, construction risk.
2 years is a long time in this market.
It is, and management acknowledged this directly on the call. They stated that 2026 must be a delivery year for these key campuses. This massive long-term promise is what separates them from, say, peers who might already have contracts signed for existing capacity. Hut 8 has the power assets or the rights to develop them. Now they absolutely have to convert them into revenue-generating capacity.
Okay, let's pivot quickly to the balance sheet because this provides a crucial buffer, maybe, against that execution risk we're talking about.
Definitely a key part of the story.
Their strategic Bitcoin reserve is a major differentiator. It stood at 13,696 BTC at quarter end, worth roughly, $1.6 billion back then?
Around that, yeah. It's a huge strategic asset on the balance sheet.
And it's not just sitting there, is it?
No, and that's important. This reserve is actively working for them. It's not just idle in a digital wallet. They use it as collateral to provide liquidity through $265 million in Bitcoin-backed credit facilities.
Okay.
And crucially, they secured this financing at a pretty low blended cost of capital, around 8.2%. Which is extremely competitive financing, really.
And if I recall, they also mentioned generating capital using that reserve without actually having to sell the Bitcoin itself. How does that work?
They did. They've generated $32 million in cash premiums through covered call strategies against their Bitcoin holdings.
Okay, break that down. Covered calls.
Yeah, so for the learner, a covered call is basically selling the option for someone else to buy your Bitcoin at a higher price at some point in the future. You get paid cash up front, the premium for selling that option contract. Whether the option gets exercised or not, you keep the premium.
Ah, okay. So it generates income and enhances their financial optionality.
Exactly. And significantly reduces their reliance on having to sell equity, which can dilute existing shareholders.
Speaking of dilution, they did launch a new $1 billion at the market, or ATM, program. That's a program allowing them to sell shares directly into the open market over time, right?
Correct. It gives them flexibility.
But critically, they made a point of noting the previous $1 billion ATM was closed with 40% of it unutilized.
Right.
And the shares they did sell under that program went at an average price that was a 50% premium to the average trading price during that period.
Yeah, that's a very disciplined approach to capital access. It suggests they are being quite smart about when and how they tap equity markets, trying to minimize dilution when possible.
Okay, so good discipline there.
It is. But this brings us right back to the core tension, doesn't it? Why the sell-off if the headline numbers beat consensus and the balance sheet looks like a fortress with all that Bitcoin?
Yeah, what gives?
I think the market is currently punishing them primarily for the massive scale of their future capital expenditure. Building out those gigawatts costs a fortune, and the 2-year lag until those gigawatts actually start producing contracted, non-Bitcoin related revenue.
But wait, if they have this incredibly ambitious 8.65 GW pipeline, and the market is so laser-focused on execution risk, how can management possibly convince the market they can deliver on time and under budget, especially with that big 2026 Riverbend deadline looming?
Well, they acknowledged the skepticism head-on during the call. They basically said the discount placed on their development pipeline relative to some peers is simply because the market wants to see us execute. They know they have to prove it.
Okay, fair enough.
However, they also stressed that the demand for the new capacity they're building is intense. They said conversations with potential AI and high-performance computing, or HPC, tenants have progressed even faster than they initially anticipated.
So they're betting heavily on the extreme demand for power from the AI sector to fill up that capacity quickly once it's built.
Yes, absolutely. And they claim they're trying to manage the inherent risk that comes with speed. Management stressed they're taking a, quote, holistic approach to deals.
Holistic, meaning what?
Meaning considering not just the potential customer, but also the financing structure for the build-out, the stability of the supply chain for critical components, and the local relationships needed for permits and construction. All to ensure they can actually deliver amid the extremely fast required delivery timelines that hyperscalers are demanding today.
Okay, so they're trying to de-risk the execution on multiple fronts.
That's the plan, yes.
And the overall vision seems much broader than just AI, too.
Yeah.
Management hinted that AI is only the, quote, first chapter.
That's right. They are explicitly positioning the platform for other energy-intensive use cases down the road, things like advanced manufacturing, robotics, maybe other large-scale industrial applications that need massive amounts of reliable power. They even noted that some sites historically earmarked just for Bitcoin mining or maybe traditional manufacturing are now seeing interest from hyperscalers purely because of the acute global power shortage. There just isn't enough power capacity in the right places.
And the ultimate corporate structure seems designed to reinforce this core thesis. Hut 8 is the infrastructure and power engine,
Right.
while the subsidiary, ABTC, remains the optimized high-margin Bitcoin mining exposure, kept somewhat separate but consolidated for reporting.
Exactly. And Hut 8 intends to maintain control over ABTC through a super vote share structure for the foreseeable future, they said. Which means that consolidation complexity we talked about earlier, that's going to remain a recurring feature of their financial reports. Investors need to get used to parsing that.
Right, fascinating stuff. Now it's time for our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea based on this fascinating bifurcation we just analyzed between the parent and the subsidiary.
Okay, let's do it. So if we agree on this fundamental disconnect that the market is punishing the parent infrastructure company, HUT, for long-term execution risk.
Right, the 2-year waiting game.
While the underlying high-margin Bitcoin mining subsidiary, ABTC, is actually performing really well right now,
Yeah.
How do you potentially play that disconnect for value?
Okay, lay it on us. How does that theoretical hedge look?
So the trade idea is a relative value hedge, focusing specifically on that structural split we discussed. Step 1, go long American Bitcoin, ABTC.
Okay, buy ABTC.
Take a bullish position on the pure play, rapidly scaling mining asset. You're capturing that potential upside from the 56% gross margin Bitcoin production growth that the parent entity, Hut 8, effectively created and housed within ABTC.
Got it. Long the miner. And
Then, step 2, you short Hut 8, HUT.
short the parent company.
Yes. Use the short position on the parent company, HUT, primarily to hedge against the near-term volatility and, crucially, the execution risk associated with building out that massive 8.65 gigawatt infrastructure pipeline.
So you're betting against their ability to deliver that on time, or at least hedging that risk.
Essentially, yes, or at least hedging the market's perception of that risk until proof points like major tenant contracts actually being signed or on-time energization of sites are delivered, likely sometime in 2026. This trade is basically betting on the immediate success of the mining spinout relative to the market's inability or unwillingness to properly price the long-dated infrastructure business in the near term.
Interesting. Long the operational miner, short the execution risk parent. A classic pair trade structure applied to this specific situation.
Precisely. Again, not financial advice, just an idea based on the call's dynamic.
Of course. So, wrapping this up, what does this all mean for you, the learner? Hut 8 delivered undeniable financial beats on the headline numbers, but that celebration was definitely muted because those figures were significantly inflated by a large non-cash accounting gain from Bitcoin.
Yeah, that's key context.
The strategic pivot to becoming a massive power infrastructure platform is crystal clear. It's backed by a strong balance sheet, fortified by that huge 13,696 BTC reserve they actively manage.
The critical takeaway, though, the thing defining the next, say, 2 years for this company is the shift from paper plans and presentations to actual heavy construction on that initial 1.53 gigawatts of new power capacity.
The execution phase.
Exactly. The question now for you, the listener, is this. Will Hut 8's stated commitment to disciplined underwriting and their whole power-first flywheel strategy deliver tangible, contracted revenue from big AI and HPC customers before the market simply tires of waiting for execution timelines that stretch well into late 2026?
That 2-year clock is ticking very loudly now, and you can bet the market is watching every single shovel of dirt, every permit application, every transformer delivery.
Absolutely. Execution is everything from here on out.
Thank you for joining us for this deep dive into the Hut 8 Q3 earnings call. We invite you to continue exploring the fascinating dynamics of energy infrastructure and the insatiable demand for high-density compute power.